Hello, everybody. This is Nrin Agarwal. I'm often asked whether one should purchase the sovereign gold bond scheme bonds in the secondary market over buying it in the primary market. Now, the primary market is basically the tranches that come out from the government on a regular basis that you can buy through your broker or through your bank account. But the previous tranches of the sovereign gold bond scheme have also been listed in the National Stock Exchange, and you can actually buy these bonds as well through your trading account. So, which one is better? Should you go for the primary issuances or should you buy it in the secondary market? Now, the first thing we need to understand is the taxation and how SGB works. There is a previous video that I have done on this that you can look at, but very quickly, the sovereign gold bond scheme basically is a scheme from the government where the bonds are issued at the prevailing price of gold. The bonds are locked in for a period of 8 years, and at the end of 8 years, you get a market link return, which means you get back whatever is the price of the gold. The biggest benefit of the sovereign gold bond is that if held till maturity, the returns are completely tax free. Also, there is a 2.5% interest that is given on a yearly basis in the bonds, but this interest is fully taxable as per the slab of the bond holder. The point to note is that the interest that is received on this bond is calculated on the subscription price of the bond and not on the market value of the bond. So very often people believe that the interest keeps changing because it's being calculated on the current market price. Honestly, there's no way for any back-end team or any registrar to basically keep calculating interest rate on the bond with the change in the market prices. So very simply, the point that you need to always remember is that the interest rate of 2.5% is calculated on the subscription price of the bond. So now, if we have to compare the latest tranche of the sovereign gold bond with, let's say, one of the previous bonds. So the latest tranche is being issued at rupees 4807 per gram. Now, I have just picked up one of the previous bond issuances, and this is a bond which is basically maturing in January 2027. As you can see, the bond is currently trading at rupees 4750. But when one looks at the subscription price of the bond, it is rupees 3214. Many investors might think, why buy the primary bond? Because that's going to be at 4,807, whereas you're getting a previous bond which is also maturing earlier at a lower rate. But the point to note is that you always need to calculate what is the interest component that you're going to get in the two bonds. So if we were to compare the interest that's going to be received on both the bonds, the one that's being issued in the primary market right now, the new tranche at rupees 4807, will have an interest of rupees 108 every year. Whereas if you were to buy the January 27 bond, that has an interest only of 80 rupees every year. So while you might get the bond at a slightly lower price, the point is that there is going to be a difference of 28 rupees per bond per year that is going to be there. Hence, it's very important that when you are evaluating buying bonds from the secondary market, always check what is the interest that you're going to have. And remember, interest is always calculated on the subscription value. I typically don't recommend buying the sovereign gold bond in the secondary market due to this reason, because investors are seldom able to actually calculate the returns. And secondly, the liquidity in the secondary markets is pretty low as well. So you may not get the desired quantity that you want. And there were some issues with CDSL. Also, I hope they have been sorted out. I really don't have an update on that. But my take would be to stick to buying the sovereign gold bond scheme in the primary market over the secondary market. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.